so what did I give you? I gave you the problems, okay, so that we can do those next Thursday. And then, what do we have? Do we have any what presentations are we doing? So, Team 1, did you do Chapter 10, APT?
No.
No, okay. And then Team 2, did you do efficient market hypothesis?
No.
And then Team 3, behavioral finance and technical analysis? No. Okay. And I don't know what I have for Team 13. Can we do the PowerPoint presentations next Thursday?
Yes.
Yeah, so we'll do so we already finished Chapter 8, right? Team 8, Team 9, you did index models and cap loss and pricing model?
Yeah.
Yep, okay. So we need to do Chapter 10 and 11, APT, and efficient market hypothesis. And we need to do Chapters 12 and 13, behavioral finance and technical analysis. Which Chapter 13? Do you have the book? Anybody got a book? Chapter 12, behavioral finance and technical analysis, and then Chapter 13 is empirical evidence on security returns. Okay, so we'll do those 4 next Thursday with the problems. Okay, so Team 1 is doing Chapter 10, Team 2 is doing Chapter 11, Team 3 is doing Chapter 12, and Team 4 is doing Chapter 13. Okay? And go into those chapters, edit those things down, yeah.
And this is next Thursday.
Next Thursday, yeah. So I'm just pushing it out. Okay. So we got the problems, we'll do some PowerPoint presentations around the book. And then what I gave you was the take-home midterm. So again, it's the same thing. You take it home, you read through the book, you answer the questions, and then just give it back to me. Okay. And then put that in deliverable too. Okay. And then what I'll do is I will this midterm, this real estate question. What you're going to do is I'm going to present my doctoral dissertation to you so that you can see how somebody like myself who was hired to basically build a series of real estate indexes. I partnered with Standard & Poor's out of New York. We built the indexes. Charles Schwab, the Chicago Mercantile Exchange, designed the standardized futures contracts to trade the indices, and S&P, Standard & Poor's, was negotiating with the investment banks to use our indices to trade forward contracts in the over-the-counter market. So I thought it would be interesting for you to see how product developers develop product, such as index product, and then how we go through the process of developing these index products. The index products can be used for exchange-traded funds. We were actually creating exchange-traded index-linked notes is what we were going to sell. So the rates of return on the notes were going to be tied to the index returns that we had developed. There wasn't a lot of indices out there in the marketplace that were actually qualified to be used as the basis for derivative trading, so we had to create it, okay, and it took us about a year to build out the data processing, all of the algorithms, back test, the indexes, and then have the Chicago Mercantile Exchange and the over-the-counter, the investment banks, make the over-the-counter forward contract trades on the indices. It was a brilliant series of products. Our timing was the worst that you could ever launch a new financial product. We worked on it in 2006. We launched it in 2007, and by 2008, everything was blowing up, and once Lehman went down, it took down everything, and we were on the street by January 1st with our severance checks. So then I basically sat on the IP, the intellectual property of this stuff. I waited 5 years until the statute of limitations had been reached. I went back to Schwab, I went back to S&P, I went back to the Chicago Merc, and I said all of the stuff that I had written and all the stuff that I had done, I want to put into my doctoral dissertation. Will you sign off on it so that when I publish it, I won't be accused of plagiarism or I won't be sued for appropriating intellectual property from the organizations. So that took about a month or two. Once they signed off on it, I went, wrote finished up the dissertation, published it, and then got the doctorate degree that I've been working on for 14 years. Okay. So what I'm going to do is I'm going to walk you through the presentation that I made on the dissertation so that you can see that a lot of the stuff that you're actually learning is applicable, and maybe someday you'll go on and become a portfolio manager or derivative trader or equity or fixed income bond trader or portfolio manager or maybe in real estate. So I took everything that you're learning, everything that you've learned in finance and applied it to real estate. Okay, it's the same concept. So it's the application of corporate finance in real estate, and a lot of it hadn't been done before. So I thought that would be interesting. So I'll do the presentation, you take the notes. Okay, so it's pretty easy. You just follow along and take notes as I'm lecturing. Okay, and then I don't think this midterm piece is going to be too hard for you either. Okay, and then the finals exactly like this, and then we don't, I'm not going to. It's going to shrink. Okay, so what I want to go over right now that you've finished deliverable 1, and you should be comfortable with the. You should be comfortable with the static passive portfolio, the worksheet that you did. So you've done the static portfolio, right? So check that off. Okay, you're done. Now that worksheet, you're going to use. You're going to use to back test the Markowitz model. Okay, so what we're going to do now is I took the Excel spreadsheet that was provided in the book, and I expanded it and spent a couple months on developing it. It's great. It's like right when you need the thing to go on, it doesn't go on. Why don't you go up to the course website, and then when I have all those spreadsheets that are listed, where the active Excel worksheet that was posted on there. Underneath it, there's an active portfolio worksheet. And I'll try to get my computer up and running while you get your computer up and running. And I'll walk you through to pull up that spreadsheet. The projector's not working. So why don't you pull up the spreadsheet? and tell me when you have it. It's gonna be the active. Investments, active, portfolio. No, don't do the back test. Do that one right there. Investments, active, portfolio 2C. Pull that up. We'll see if I can get the projector to cycle through, but why don't you pull that up so I can walk you through it. And tell me when you have it loaded. You got it? You got it? Okay, cool. So what you want to do, go up to the top of the page, and what I'll do is I'll walk you through the whole spreadsheet. Back in business. So everybody got the, okay, perfect, go to the top, go to the top. Got it.
So it was 2C?
Yeah, 2C. It's 2C. 2C, you got it. You got 2C, 2C, 2C. You guys are sharing, happy, you're all ready? Let's test this. It's going to be meeting. Okay, you want to read through, this is the optimization. Okay. And here are your companies. And these should be all linked. So there's a company page in the back that's going to link to this page. So these are your companies, right, that you've already done. And then here are the instructions to do the solvers. This is the portfolio optimization page, okay? And I'm going to walk you through this. It's probably going to take a couple times to walk you through it so that you understand what I'm talking about. It's pretty complex and it's a little bit tedious and laborious, but when the thing works, it's pretty awesome when you get it done. When you see the results, it's pretty amazing. So I'm just going to walk you through it first. So all of this stuff is linked, so don't be moving any rows or moving any columns or anything. You gotta be really careful. Okay? So all of this stuff is gonna be calculated for you. So it's gonna be an input, all right? The only thing that you're gonna input is this right here. So what these are right here are you can just leave it as 2018. What you're doing is you're estimating the expected return on each one of your stocks going out 1 year. So you've already done some back testing on your individual stocks, right? You have the 1, the 3, the 5, the 10-year back testing. You have a forward test, a year to date already calculated. So what you can do is you can say, okay, I think that next year, over the next year, that Apple stock is going to return 22% or 15% or whatever you think it is. We could run intrinsic valuations around it to calculate the premium, or the discounts, but the premiums, and say, okay, we think Apple stock is going to be worth X in the future. We calculate the percentage change, and that's what we think the stock price is going to go up by over the next year. Where you go back and you look at the 3-year, the 5-year, the 10-year, you say, hey, Apple stock has gone up around 22% per year over the last 5 years. I don't think it's going to go up 22% next year. Maybe it goes up 8, or 12. For each one of your stocks, you plug in what the price appreciation rate is going to be next year. Okay, is everybody clear on that? Okay, so this is you're going to have to do the research and then hard code the returns in here. And then this kind of tells you, you know, if you wanted to spend more time in calculating the values of where the stock price is gonna be in a year from now, then you could use these other methods. You could use the intrinsic valuation method, you could use the technical securities, trade momentums, trending, you could use time series and cross-sectional regression models to figure out the expected returns. You could use arbitrage pricing theory to figure it out. You could use CAPM if you wanted to. You could use an exponential moving average or a Holtz-Winners method to be able to forecast that. Maybe you guys have done that in your quant class. And you could use other analyst reports. There's a lot of analysts are out there that basically project out what they think the stock price is going to be in a year from now. So you come up with some, what I did here was I showed, this is just a table that calculates from some of the summary statistics, and I'll show you in a minute. This shows you the standard deviation on Apple. This is the total variance. There's your correlation. What I did was, since Apple, and actually what you might want to do is, depending on the portfolio that you build, you might want to swap out one of your stocks and put in the S&P 500, you know, as an index to be able to run the correlations amongst the across the index. What I did was I did a pure tech portfolio. If you look at all the tech, if you just look at the S&P 500, and if you look at tech indexes, particularly market cap weighted indexes, everybody's correlated to Apple. I mean, Apple is what, like $1 trillion company, right? Apple, Amazon, Alphabet, you know, those are the top 3 companies within the tech sector. So all the other tech companies are correlated to the dominant tech companies. So what I did was I used Apple to be able to run my correlation matrix. Obviously, Apple is highly correlated to itself, but you can see that Oracle's stock price returns over the last 5 years is about 71% correlated with Apple. Amazon, negative 57%. So this just gives you kind of an idea, you know, of the correlation, you know, amongst Apple. And then here, this gives you the covariance. This is the mean average return for these stocks over the last 5 years. Okay, and I calculated the mean and the median. So you do some of this. You look at this. You know, I thought in 2018 that Apple could do another, you know, 22%. Well, as we know, if you look at Apple stock, Apple's kind of careened over the last 3 months. Its pricing's back to where it was before its correction. But I would probably take this down to maybe 12 for 2019. And then I just go through all the stocks and I plug in what I think the returns are going to be over the next 12 months. So that's the first. Then here, this is the covariance matrix. And I'll show you the data behind this, okay? And we're gonna have to run the covariance matrix. So I'll show you how to put the data in. The data's gonna calculate the returns. Then you're gonna take the returns and you're gonna run the covariance matrix off of it. And then it's gonna update the covariance matrix here, because the covariance matrix is what you need to run the optimization on to be able to kick out the portfolio standard deviation. Okay. And again, this is the first time you've been through this. I will walk you through this like 3 or 4 more times. And as you work through it, I will be coaching you and training you as you move through the whole process. Okay. So there's the covariance matrix. Then here, what we did is, here, this is, you want to read all this stuff. So what I did was here, these are the returns for the 25 stocks. What I did is I took right maximum rate of return of any one stock within the 25 was 22%. The minimum was 3. Okay. So then what we're going to do is we're going to run 15 iterations. We're going to run 15 portfolio iterations. This is going to trace out the efficient frontier. So we're going to do 15 iterations, and it's going to trace out the efficient frontier. I'll walk you through that again. What I do is I took the returns, the minimum and the maximum returns, divided it by 15, and came up with these return iterations. Okay, so these are going to be the, in the efficient frontier, right? You have expected returns and portfolio standard deviation, right? So these are the expected returns, and then we're going to run the optimizations to kick out the portfolio standard deviations at each interval return. And I'll show that in a minute. So what we do is, what we're going to do is we're going to plug in right here. So this is the first scenario, right? This is the first scenario. So we basically plug it in right there. Then what we're going to do is we're going to run the optimization. Okay, so you got to make sure that you go up to data here, and you're going to go up to solver. Sorry, data, and then there's what? Where is it? I'll show you that in a minute. And I'll show you how to add the solver application pack. Actually, I think it's here. Oh, here we go. Yeah. So you go down, did you everybody see that? So you want to go, do that again. So you want to go File, go down to Options, go down to Add-ins. There we go. And then what we're going to do is we're going to add in the data analysis tool pack. In the solver. So we're going to add in. Oh, there we go. So you're going to add in the solver, and you're going to do the data analysis tool pack right there. Okay. And then click OK. All right. So if you go back up to data, then your solver and your data analysis tool pack is right there. Okay. All right. Then what we're going to do is we're going to do the first iteration here. And then we're going to run the solver. I'm not going to do it right now, I'll show you later. But then you'll run the solver. And what it's going to do is at 22%, it's going to kick in right here. And it's going to kick out that row right there. That's where it's going to print the results of that optimization. And then what you're going to do is you're going to go right here, take the cell D81, and the instructions are all laid out for you. Okay. So then you take this D81, go down here to D107, right-click it, copy it, put it right there, and then paste it as a value. Grab it, copy it, put it right there. Don't do this one because these are all programmed. Right, click it and then paste it as values, and then boom, it's going to go in. Okay, and then what we're going to do is we're going to take the next one, which is 20.7, put it in there, run the solver. It's going to kick out right here the results. You're going to copy the results that come out, and you're going to right click it, copy it, and you're going to paste it right here in the right there. Okay. And you're going to run through and do that 15 times. Okay. So what you're doing is you're calculating the portfolio standard deviation for each of the returns. Okay, for each of the returns. And then what you need to do is you need to bold these positives right here. And then what we're going to do is we're going to take the portfolio allocation for the portfolio iteration that provides us the highest return to risk ratio. Because we want the portfolio that's going to give us the highest return to risk. And if we were to take out, we did the returns minus the risk-free rating would be the Sharpe ratio. But what I did was I said, forget it's probably slightly wrong, but it's more intuitive. What I wanted to do is I wanted to use expected returns on the portfolio, not the market risk premium. I wanted to use the actual expected returns. And then I wanted to use a simplified Sharpe, taking out not using the risk-free rate. So as you can see, my portfolio has given almost 3 units of return per unit of risk. Is that good? If you were a portfolio manager and you went to your clients and you said, I could provide you 3 units of return per unit of risk, and I could also get you an 11.9 or 12% annualized rate of return on the portfolio, would they be happy? Absolutely. Do you think if I raised money to put money into this, how much AUM do you think I could get under management? If I was providing almost 3 units of return per unit of risk, and my portfolio was basically performing at almost 12% per year, back tested over the last 5 years. Would that be good? Yeah, absolutely. Okay, so that becomes, this allocation right here, becomes the allocation that you use in your passive portfolio worksheet. You remember when I went around and I checked your allocations to see if the allocations were too high, right? And I took the revenues down and brought them up a little bit to recalibrate the portfolio. That's what you do. You go back into the market cap or the revenues, whatever you used, and you start manipulating them to replicate this portfolio allocation, the active portfolio allocation. Now, since you already have the data in that passive worksheet, you can back test the performance of this active portfolio. So you already have the back test Excel spreadsheet. So now you ran the active optimization, the active portfolio strategy, the approach. You've got the allocations. You basically replicate these allocations within your passive Excel spreadsheet, and now you back test and forward test your portfolio, and you see how you did. Okay. So the most tedious part of this whole thing is running the 15 iterations and not copying and pasting over this row right here, because that's programmed. And then this program here, you don't want to copy and paste over this, because this is, right down here, is also programmed. So you have to be really careful when you work in this worksheet that you're not screwing up the formulas. It's just like any Excel spreadsheet anybody hands you. Anybody gives you an Excel spreadsheet, do not just start working in the spreadsheet. You need to audit the worksheet, know exactly where all the formulas are, and then know how to do the inputs, the procedures to be able to run the programming. Don't just assume that you can just start playing with it. Okay? I see students do that a lot, and they screw up all the programming, and then they have to upload the software again, the application, they have to put in all the data again. The other thing on this worksheet, do not share it, okay? Do not use Google Worksheet. You need to you gotta work with it in Excel, okay? In Microsoft Excel, and it's gotta be one person at a time, okay? Because the last couple semesters ago, I had a couple students that were sharing this file, they blew it up, okay? And then they tried to do it again and they couldn't do it. So it was really frustrating for them because they were sharing it, trying to share the inputting and the workload, and they contaminated the optimization and blew up the spreadsheet, okay? So you have to do it, if you're gonna share it, you know, if you're gonna work on it in a team, you gotta open it and close it in Microsoft Office, okay, in Excel. So it's gonna be really clean, opening and closing it, okay? And then here are the instructions with the actual pages of the first iteration that you're gonna do. So you're gonna run the first optimization that you're gonna run is this one. And the first one you're gonna run is the minimum variance portfolio. Okay, so you have to run that optimization. Then you're gonna use this optimization with these parameters to run these 15 optimizations, okay? Then you're gonna run one more at the end to calculate the capital allocation line. So if you can work through all of these procedures, and I got everything documented, okay, step by step, this is what your efficient frontier should look like, something like that. So here's your capital allocation line. This portfolio, these portfolios down here are inferior portfolios, right? Because they're giving you high portfolio risk at low returns. So these are out. These you would probably short. You would short these. But we're just doing a long portfolio strategy here. So we want to take that portfolio that is tangent to the capital allocation line, okay? And I didn't put in the utility curves here. I could have done that. I might do that someday. But that portfolio right there that's tangent to the capital allocation line is this portfolio right here that gives you the highest return to risk. Okay. So that's what you're looking for. That's what you're trying to get to. Okay. And I'll bring in some examples of some reports. So this walks you through again. This here, step one, solver one. Step two, second step here is this one here, and that one here is that one there. So I just blew it up so you can see what it looks like. Okay, so you don't make any mistakes. Okay, and then here, oops, this is just a separator page. This is your covariance matrix. Okay. This explains to you how to run the covariance matrix. This one tells you how to run the correlation matrix. But you can't run the covariance matrix or the correlation matrix until you put in all of the data. Okay? And to run the correlation of the covariance matrix, you gotta run the returns. So here are the returns. Now, what I did, and I'm not sure I did it the right way, but this is the way that I did it, because I like large data samples, right? When you have the law of large numbers, when you have very large, normally distributed data sets of returns, what does that allow you to do? What can you calculate with a normally distributed data set of standardized data? What do you get to do?
Probability.
calculate the standard deviation, excellent. And is the sample standard deviation gonna approximate the population standard deviation, if you have a large sample? Yeah. What else does it allow you to do? I got standard deviation, and I got, what do you calculate? If your distributions are nice and tight, what can you forecast? What's in the middle of the distribution? It's the what? Is it the median? Come on, test questions, you did the pre-test. What? The average, and it's called the mean, okay? So if I have a tight distribution around the, if I have a tight distribution, what does that mean that I can forecast? You just said it. I can forecast the mean return. I can forecast expected returns. So I need a large data sample, okay? If I calculate over 10 years, if I calculate annual returns, how many data samples do I have when I'm doing annual returns? For over 10 years. Do the math. 10 years of annual returns. How many data samples do I have? 10. Is that a large sample? No. Okay. What if I take quarterly annual returns? How many data points do I have per year? 4. How many years? So I got 40 data samples. Now we're starting to get somewhere. What if I do monthly? Year over year on a monthly basis. How many do I have per year? What is it? 12? And how many years? 10? How many data samples do I have? Yep. Now I'm starting to, through manipulating the intervals, the data intervals, I can start to get larger data samples. What if I do daily? Daily year over year for 10 years. What is it? 3,600. Is that a large data sample? Yeah, it is. So what I did was I said, okay, let's do year over year daily for 5 years. Okay. So what, I got 1,500. So I basically got half of the 360, right? So now I'm getting like 1,200, data samples. Probably won't use 200 of them. So now I got 1,000 annual returns. Is that a large data sample? Yeah. Do you think that the distributions are going to approximate a normal distribution? That will have relatively stable standard deviations and expected returns? Yeah, that's what we want. Okay? So that's what I was trying to do here. So these are your returns that are calculated. And if you do this right, it calculates a lot of the stuff for you. So you're doing a lot of the procedures. So I got total returns, 25 stocks on a daily basis. What is it? 1,007. Okay. It may not be the best way to do it, but this is just the way that I did it. Because I wanted a large data sample. So now let's get to the data. So this is where I basically copied and pasted from the passive portfolio. From the passive portfolio, I copied these columns and I pasted it, bam, right there. Okay. Now what I can do, right here is the NASDAQ. Okay, so what we're going to do is that's all you got to do is walk through these procedures and I'll show you how to do it. Is you go up to the NASDAQ website. So you may want to go ahead and do that. You might want to do this because this is the hardest part of the whole thing. So I would go up to the NASDAQ website and you can, and the instructions are there. It walks you through step by step on how to do this, but I'll show you how to do it. So there's your, maybe somebody can read out the instructions from the worksheet. What does it say? It says go to NASDAQ.
Go to the quotes tab.
Okay, yeah, so read it out to me. Go to the quotes tab, right here, got it.
Go to step 1, get a stock quote, enter up to 25 symbols.
Nice, so we already have them. So what I did is I went back over here into my spreadsheet. I went over here, I copied the 25 tickers, here, pasted them. What is the next thing that it says? What? Click on what? Say that again? Doesn't it say get summary quotes or something like that? Or just hit enter and see what happens? Oh no, that's not what you want. Oh, there it is. Got it. So then just hit enter. And now all of your stocks are right there. Okay. So then go to, for example, go to Apple. Right? So I'm now on Apple. Now go to historical quote. Am I going too fast? Nope. Then what you want to do is you want to go, this is the time frame. So you want to go back and do 5 years. Click on that. Now it's got 5 years of data. Okay. So I got all the data right there. Then what I do is I go down to the bottom. I click on this, download this file in Excel format, and click on it. And it's going to bring up down here, right, your CSV file. Click on the CSV file. And it's going to pull up the data. Okay. And then what you're going to do is you're going to capture that data, grab that data right here, go all the way down, go get all the data, right click it, copy it, go back to your spreadsheet, okay, go to, you're going to need to put in the tickers here for your stocks. And then what you do is you go up here into this page, make sure you're at the top of the page, right here, we're missing the A, go right there, right click it, go over here to values, and bam. Okay, so what this does is it basically provides a histogram of the year-over-year annual returns for the 1007 data sample. Does that look like a relatively normal distribution? Yeah, I mean, it's not skewed and it's not all, there's no binomial, it looks relatively normal. So what does that tell you about the standard deviation and the expected return? It means they're stationary, okay? You have a really large sample here. It's relatively normal. So you have basically relatively stationary expected returns and standard deviations. If you have relatively stable, stationary expected returns and standard deviations, you can run mean variance analysis. You can run the Markowitz optimization procedure, okay? This is what you guys live and breathe, is mean variance analysis. That's all your life is as a portfolio manager, is building and breathing mean variance analysis, okay? And that's what I was trying to do. Then what you should do is run through this procedure right here, okay? Using the data tab to calculate the descriptive statistics here, okay? And the descriptive statistics are going to be right here. And then what you're going to do is you're going to check the descriptive statistics against these calculated standard deviation means and medians. These three cells right here, if you go back up to the original worksheet, the stock portfolio optimization tab, and you go up to the top, that's where these come from. Okay, so that's where they're coming in from. So everything is linked. So there's Apple. Here's my histogram, looks pretty good. here are the 365-day annualized returns. Okay? So since Apple has been around for over 5 years, I've got a pretty nice time series of 113 returns. I mean 1,013 returns. Because I did year over year for 5 years. Okay. For those of you who have stocks less than 5 years, we're going to need to talk. Okay, we're going to need to talk. Because the problem's going to be is you're not going to have a lot. You're not going to have 5 years of return data. Okay. So what we're going to have to do, let's say for some of your stocks you only have 3 years of data. You got to figure out the last 2. So you're going to have to interpolate the 2 years of returns. How do you do that? Well, what I do is I would do a 3-year correlation matrix. And I would find a stock that has 5 years of data that is highly correlated with the one that only has 3 years of data. And I can multiply the one that has 5 years of data times the correlation coefficient to get the one that doesn't have the 5 years of data and plug in the last 2 years using the return for the one that does times the correlation to input the data. Okay, I'll go through that over again. So we're using another stock that has 5 years of data against the one that only has 3 to get the correlation, and then we multiply the correlation coefficient against the one that does to get the returns for the one that doesn't. Does that make sense? Do you follow, or have I already lost you? I'll go through it again and again. I'll show you how to do it. I'll be walking around, checking all your work and walking you through these more technical procedures. So once I got the returns, I got the distributions, and you can see that Apple stock has basically returned on average 22% per year over the last 5 years. Is that pretty good? Yeah. And then if you take the mean, which takes out the outliers, and you just take the median, it's returned around 19%, or 20% over the last 19.6, so 19%. Can Apple do another 19% next year? I don't know. Maybe, maybe not. You'll have to figure that out. But what I usually do is I say, okay, I don't think it's going to do 22. I don't think it's going to do 19, but it may do more than 12, so maybe I'll put in like 14 or 16. Okay, and just, I know it's going to be significantly higher than a lot of the other stocks because it's a monopoly. Maybe not as good as it's done historically, but I'll give it a number that's relatively high. Okay, and then I basically run the same procedure. IBM. This one looks a little, yeah, it's a little skewed, but still pretty normal. There's Microsoft, that's pretty normal. There's Oracle, that's pretty normal. There's Salesforce, there's SAP, that's pretty normal. Amazon, Baidu, Facebook, what is that? Cisco, Google. So again, kind of gives you, an idea of these distributions. So you do that for all 25 of your stocks, and then I'll edit. I'll take a look at your stuff and make sure that it's done correctly. Okay, so that's that piece. And then what we're going to do also is, okay, so in your, what you're also going to do you're going to need to designate a portfolio manager. You're going to need to designate a technical analyst, and you're going to need to designate a fundamental securities analyst. So you need 3. And I would designate somebody as the specialist. So Somebody does the technical, somebody does the fundamental, and then the other person is the portfolio manager. They kind of bring it together. So go up to stockcharts.com. Put in Apple's ticker. This is just an example. Here's the technical chart right here. You got the RSI at the top. You got the MACD at the bottom, which is what I want. Is everybody following along? I want to make sure I'm not losing anybody. Everybody following? Okay, slow me down if I go too fast. Then you want to go right here where it says fill the chart. Click on that and go to, I would do 3 years. So go to 3 years, click on it, and then click on update. So now I'm going to get the 3-year chart. Okay. Then what you're going to do is you're going to go down here to the overlays. And you're going to change this to 10-day simple moving average. You're going to change this one 30-day. You're going to go back down here, click on the drop down, go to simple moving average here, and it's going to plug in the 50, and then click on update. Okay, so this is my Apple chart. So there's my support, there's my resistance. Looks like it broke out there. Looks like it was on a run. This could be a support or resistance. Looks like the resistance turned into the support here. Looks like it broke through the historical support here. This looks like the peak right there. I don't see a shoulder there. That could be a shoulder. This looks like a resistance there. Trading range, trading range, trading range. Is it in an upward trend? Yeah. So I might do a trend, something like that, to get the trend on that. So just really quickly kind of looking at the overall technical patterns, within it. So the technician, should be, looking, the chartist should be going through, printing these out. Okay, I would start off with printing these charts out, one per page, okay, and then conducting some preliminary technical analysis on it. And would this be a stock that we would want maybe overweight? Do you think in the portfolio optimization, in the active portfolio Markowitz, the active optimization procedure, it takes into consideration return on the stock. That's why Apple gets a larger weight in the portfolio, because it's performed so well over the years. Okay, so this would be kind of my first technical analysis as the technician. I would be looking for patterns, and if you as the technician, if you want to spend more time actually getting into technical analysis, there are technical analytics posted to the technical analysis section of the website. So you can read up on technical analysis and technical trading methodologies if you want to become a trader. If you're interested in becoming a trader, you got to learn how to trade off the technicals. I can use fundamentals, but I like to use fundamentals and technicals in combination to be able to execute on better trade opportunities. Okay, so here, as you can see, the green is going to be your 50-day. Your 50 day is kind of smooth, right? And then the 30-day is going to be your red, and then the blue is going to be the 10-day. So the 50-day is very smooth. The 10-day is more volatile, and 30 days in between. Okay, so here you can see that the 10-day across the 50-day right there. And then you can see the 30-day right here confirmed it. So this, when the 10-day crosses the 50, this is your sell alert. And when the 10-day and the 30-day cross the 50, this is your sell signal. Okay. It's a rules-based trading system. Okay, you just follow the rules. Okay, so you're going to sell there. The 10-day looks like it almost crossed the 50, but it didn't. The 30-day never really crossed the 50. It wasn't until in here it looks like the 10-day crossed the 50 there. So I was still short here, or I was out of my position here. Or I basically bought puts right here or wrote calls. So I was just still making money down in here if I wanted to. But I got out up here and the stock price went to here. So then the 10-day crossed the 50. There's my buy alert. And then the 30-day crossed right here. That's my buy signal. So I bought right there. I bought right there. And then the 10 and the 30-day stayed above the 50 all the way up to here, and I sold it. So I bought it at what? Like 110, and I sold it at 120. Okay. Is that making money? Am I making money? I'm making money. Okay. So this thing's a money machine. So then I sold it there, held my position, held my short position, or my put, or my calls, and then the 10-day crossed here, there's my buy alert. 30-day crossed, here's my buy signal. I bought Apple stock here, bought the calls, bought on margin, and basically rode it all the way up to here. So I bought it at 120, and I sold it at 150. Am I making money? Yeah, I'm making money. So just buying and selling, I could be making money. I can make even more money if I'm buying on margin and going short. I can make even more money if I'm buying on margin, going short, and I'm writing and buying the puts and the calls. Okay, it's a money machine, okay? And it works. So here, again, what I'm doing is I'm marking all of the period times when I'm buying and selling based on the moving average crossover system. Then what you do is you go here into this investment profit loss moving average portfolio calculator, number D. You put in the number of shares. Remember from your static portfolio worksheet, it kicked out the number of shares, right? You have the allocation, allocations times the million, gave you the money, divided by the share price, gave you the number of shares. So you basically take from the passive portfolio strategy, you put in the number of shares for your 25 stocks. Okay. You go back to your technical analysis worksheet and you identify where you bought and where you sold. Okay. In what time period. So that was my here. This was probably my first trade over here, back in here. So what we're doing is we're back testing the moving average crossover trading system, technical trading system, going back over a 3-year back testing period. So basically I go in and I look at the 10-day, the 30-day, the 50-day. I look at the buy sell alerts and the signals. I log in when I bought and sold based on the technicals. So over 3 years I had 4 trades for Amazon where I bought and sold it. Okay, based on the technicals. It's going to calculate the profit that I made on Amazon. It's going to calculate all the profits from all of the trades that I did. So overall, $1 million for the 25 stocks, implementing the moving average crossover system, the technical trading model, I made over 3 years, almost $250,000. I made on average $80,000 a year. In my first year, I made $52,000. Second year, I made $94,000, and I made $95,000 in year 3. That's almost a 10% return on the $1 million. So between your passive strategy, your active strategy, your technical trading strategy, you're making money hand over fist for yourself and your client. Are they going to be happy? Yeah, because they're going to pay you a fee of a point for the passive strategy. They're going to pay you maybe for the active strategy. They may pay you, a point and a quarter. Then you go back to them and say, well, we designed a foolproof technical trading system that can yield enhance your portfolio by actively trading it. So they're going to add another 100 basis points. Now you're at 250 basis points. Oh, and by the way, we're really good at going on margin, going short, buying and writing calls in a dynamic fashion. We can actually generate 40% annual returns, maybe 50% annual returns on your money. Now we can double your money in less than 5 years as opposed to 10 years. Does that sound like music to clients' ears? Yeah. And yours, right? And yours? Yeah, exactly. So that's the profit loss. I'm just kind of walking you through this stuff. How am I doing on time?
20 minutes.
Okay, yeah. So I just wanted to give you an orientation on this stuff. And then the last piece of the, if I can find it, hold on. Okay, here we go. This is C. And I made a mistake. I didn't start having my students work on this soon enough in the semester. I usually wait, till after the midterm to do it, but it didn't work last semester. The students weren't able to get this done right. So you need to identify a fundamental securities analyst that's going to specialize in this. I'll show you how this thing works. So this is just a calculator sheet here. This is just your company input page, so you're tracking that. This is this you don't input in this page. This is an output page. So this is basically the valuation summary for the first 6 stocks, 7 to 12, 13 to 18, and 19 to 24, and number 25. Okay. So here's Apple. Okay, and you guys, does anybody know Dakota Armor? Anybody know Dakota? Dakota programmed this. Okay. We went over it. He programmed it. So you should call him up and tell him, how amazing this thing is. It's pretty amazing.
I would never admit that to him.
Huh?
I would never admit that to him.
Yeah, I know. I would know. So here's the worksheet. So let's go through it. So what you don't want to do, this is an output over here. So don't be messing with that stuff. Okay. So here's Apple over here. Okay. So what we're going to have to do, since we're in 2019, okay, we're going to have to go back and change some of this stuff. Okay. So here, the first output right here is going to be 2018 earnings per share for Apple. Okay. And then for those of you who took my 123, this should look familiar. Okay, because this is basically what you did on the exams and what you did in the stock valuation. Okay, we just programmed it. You did it by hand. So we have the 4 valuation methodologies here. We have perpetuity, Gordon growth, multiple, and DCF. Okay. We have here, we've got the expected returns. So we basically said, okay, I'm an investor. My expected rate of returns are between 8% and 10%. So we're going to use 8%, 9%, and 10%. If you're doing small cap stocks and you're doing mid cap stocks, your discount rate might be a little bit higher So you're gonna have to feel comfortable with it. Maybe having different expected returns, different discount rates for your different stocks. But in this model, what we did is we said, okay, screw it. What we're gonna do is just have the same expected return for all of the stocks. But you may be looking at some highly volatile mid-cap tech stocks where you're gonna probably wanna apply a slightly higher expected return. Maybe it's 9, 10, 11 instead of 8, 9, 10. Okay? So once you set the discount rates, which are here, okay, and we know that if we calculate, we can estimate, in this case we were using 2017 EPS. I need to forecast what the earnings per share is going to be next year. We're assuming a 5% growth rate. So what I would do is take the 2017 EPS, multiply it by 1.05 to get the next year's earnings per share, and then we take next year's earnings per share and divide it by the expected return sensitivities, and it pumps out the valuation range right here for the stock. Then we're under the perpetuity model. Your assumption is that the earnings per share are going to remain flat forever. Okay, so you're going to grow it out, which it does. Apply the discount rate sensitivities, which is going to kick out the intrinsic values using the perpetuity model. Okay, that one's done. Then the Gordon growth is going to be the expected returns minus the constant growth rate. So this is the Gordon growth valuation matrix. Okay, so that calculates the intrinsic values using Gordon growth. You're going to have to go in. We did it very simple. We used the same multiples for all the stocks. Multiples are not the same for each stock, right? So you're going to have to manipulate the multiples, because what will happen, if you're not applying the right multiples, you're going to get really low intrinsic values, okay? And they're going to be below the current stock price. And you're going to have a sell signals, and you're going to have an underweighting because they didn't. The intrinsic valuations weren't accurate. And I can walk you through this stuff earlier in the semester so that we can add a little bit more precision to this procedure. Okay. And then down here, you have the discount rates, and then you have your earnings per share growth rates over the 5-year holding period. Then you're going to apply the Gordon growth to get the terminal value. This thing is going to go ahead and discount the earnings per share and the terminal values to the present to get the present value using the discounted cash flow method under the different discount rate scenarios. So here's your present values. Then what you're going to do is you're going to pick the values. These already pick the midpoint values in these things are listed here. And as you remember, these are the weights. So we're weighting the different intrinsic valuation methodologies to get a final intrinsic value for Apple stock. And we take the intrinsic value, divide it by the current stock price, calculate the premium or the discount. Okay. So you run that for all 25-year stocks. And then what you do is and this is not, unfortunately, this isn't programmed. If anybody wants to program this for me, I would appreciate it. So here, this is how it is. So here are your stocks. Here are the tickers. Here's your 2000, this will be 17, 18, 19 earnings per share. This is the valuation for the perpetuity, the Gordon growth, the multiple, and the discounted cash flow. Here's your final intrinsic value. Here's your current stock price. You're going to basically calculate the percentage change between these two, and you're going to get either a premium or a discount, and then you're going to have to sort this from high to low. So these stocks right here that have a positive premium to the current stock price, these are probably the ones in your final target portfolio allocation because you did the passive, you did the active. Now you're going to reconcile the two. You're going to go look over here and go, okay, I got HCP, I got Liberty, and I got Bernardo. These three stocks, I believe, are going to be trading at a significant premium over the next year. I'm going to want to overweight them within my target portfolio. And these stocks down here that have significant discounts to the current stock price, I'm going to want to underweight these. So your final target portfolio, you're using the passive, you're using the active, you're using the fundamental securities analysis, and you're using some technical analysis to come up with your final target portfolio allocation. Take those allocations, save down your static portfolio again, replicate the weights, back test, forward test it. Now we've done 3 portfolios, okay, that we can sell. We can sell a static portfolio approach, we can sell an active portfolio approach, we can sell the target portfolio approach as a 3rd portfolio, we can sell the moving average trading system to the client as a yield enhancers to get more money from our side in active trading and from the alpha that we're going to generate off of that. The fundamental securities analysis, we can sell this research as analysts and investment advisors to the investment community and make money on our research, doing it that way. There's a lot of ways we can make money off this thing. Okay. And then the last piece, towards the end of the semester, what we're going to need to do, and I haven't built this one yet, so if somebody wants to work with me on building this worksheet, is this one. So basically we have our stocks here, we got the tickers, I got my forward PE, I got my return on equity, I got my return on assets, I got my dividend yield, I got my leverage ratio, and I got my beta, okay? And here are the weights. What I can do is I can calculate the mean on this, I can calculate the average, and I can calculate the standard deviation, okay? So if I do that, if I calculate take the actual for these, minus the mean divided by the standard deviation. What does that give us? Do you guys know that? What that equation is? The actual number minus the mean divided by the standard deviation. What? No. It's called a z-score. It's a standardized unit. So what I basically do is I go back and I put in z-scores for all these. Put in z-scores for all of these, all of these. And then what I do is I can add up. The z-scores for each one of these stocks and then rank them. Resort the table so that the companies with the highest z-scores, those become the companies with the best fundamentals. The best PE, the best ROE, the best ROA, the best dividend yield, the debt to equity that's not over leveraged, maybe a beta, it's close to the market or something. So I can create a standardized scoring system, create an index for each of the individual stocks based on the accounting fundamentals, and resort them from high to low, and that becomes another input into my overweighting or underweighting rationale. You guys have never done this, have you? And I can also weight these too. I can weight the Z scores. So the weights add up to 100. Because I'm obviously gonna rate ROE fairly high because that's the number one metric that's gonna determine stock prices. ROA is really important. If I'm an income investor, dividend yield is gonna be important for me. Conservative leverage is gonna be important too. And not extremely high betas will be important for me too. So I can create a weighted Z-score, resort the companies, and that's another fundamental approach to be able to pick and weight stocks within my portfolio. Okay, am I out of time? Okay. Yeah, I'm out of time. That was pretty hardcore stuff. So that's basically the rest of the semester, okay, that we will be working on. Okay, so I wanted to give you an orientation. Now what we'll do is we'll back up and we'll start methodically going through and taking these out. But I would pick your technical analyst, I would pick your fundamental analyst, and I would pick your portfolio manager. Okay. Okay.